I don't know. Leave that up to you. You can use it or you can use the arrow key.
Okay, guys, Roman.
Okay. Yeah.
Okay.
Is everyone ready?
Yeah. Start.
Hallo, bitte. Hallo. Sie brauchen noch ein Headset? Ja. Bringen Sie von hier den Kollegen. Und dann einfach gleich los. Hallo. Sie kommen
I just did quick.
Yeah. Let's get recorded.
Exactly.
Das ist okay, wir können loslegen.
Ja, okay.
Du bist auch schon mal den.
Ich denke,
Ja, sorry, what's true?
Okay, let's do it. Let's start.
Yeah, well, we will open that strings. Yes, yes, there should be.
I'll get some.
Yeah, yeah, cool. Yeah,
Yeah, I'll get some.
Mr. Kammer, dear guests, dear students, on behalf of Goethe University and the Institute for Monetary and Financial Stability, I'd like to welcome you. We are here this afternoon to participate in the launch of the IMF's Regional Economic Outlook for Europe 2022. The location of this event, I think, is very much befitting an IMF participation. A stone throw away to the South. Some decades ago, John McCloy had his office, having left presidency at the World Bank, become High Commissioner for Germany. During his work as a High Commissioner for Germany, he was involved in the creation of the Marshall Plan, accession of Germany to international organizations, such as the IMF. But he was also involved in discussions at the time whether to restructure the role of government for the German economy in order to deal with the repercussions of the Korean War. Unfortunately, today we are again dealing with the repercussions of the war. Fiscal policy is in the limelight again, fortunately not in the way that we would have started to discuss the very fundamental organization of the German economy. But nonetheless, it is very clear that moving forward, fiscal and also monetary policy will need to find answers to the challenges that they're facing. And perhaps these challenges have also been made more probing by the fact that in years past in Europe, unconventional monetary policy was pursued without too much of waiting on what would happen when inflation risks reappear. examine these issues for fiscal monetary policy in greater detail and provide a multilateral perspective on how to move forward. It's a great pleasure to welcome Alfred Kammer, the director of the European Department at the International Monetary Fund. Alfred Kammer's exposure to economics actually also has roots not far away from here, with undergraduate studies at the University of Würzburg. But his work since then has become distinctively global. So joining the IMF in 1992 to the economies program, Alfred Kammer has inter alia worked on the transition of Eastern European economies in the 90s, including time as the IMF's resident representative in Russia during the year 1998 financial crisis, and subsequently directing at the IMF the Office of Technical Assistance Management in the aftermath of the global financial crisis. Prior to becoming head of the European Department, Alfred Kammer has been advising the IMF's former managing director, Christine Lagarde, and also the current managing director, Kristalina Georgieva. In the final remarks from my side, let me also welcome Jenna Render, who, following the presentation by Alfred Kammer, will guide a conversation with Alfred Kammer, as well as moderate the subsequent Q&A part of today's event. In this context, also a warm welcome to the online participants who will have an opportunity to ask their questions to us here today as well. Jenna covers European Central Bank as a senior reporter for Bloomberg News, and is probably also known to many of us as being the co-author of 2 books on Mario Draghi. In her books, she has noted that Mario Draghi made his mark with deeds rather than words. Maybe some of us would have first thought words were the hallmark, but Jana argued it was deeds rather than words. And so I trust that this afternoon as well, she will put the focus on deeds rather than words. Once more, welcome, and it's my pleasure to give the floor to Alfred Kammer. It's all yours, please.
Thank you, Michael, for this kind introduction. And I'm very pleased today to be here at Goethe University, and that we, together with the Institute for Monetary and Financial Stability, are co-sponsoring this event. The university and the institute have a very rich history in terms of research, and in particular on the debate of monetary and financial policies in Europe. And we are at one of these junctures where we have actually more questions than answers when it comes to policy making. And we will certainly increase probably the number of questions today on what we need to think about in terms of monetary policy in the current conjuncture with inflation very high, and with fiscal policy shouldered with so many objectives and needs to be aligned with monetary policy. So this is an important juncture conjuncturally to discuss this issue, and it's therefore a particular pleasure to be here at the Institute. I start with a presentation of our regional outlook. And the bottom line is our outlook has started quite a bit under the confluence of adverse forces. On the left chart, we can see that natural gas imports from Russia have dried up, pushing Europe into an energy crisis that is weakening real incomes and domestic demand. In the middle chart, you can see how external demand has weakened further as growth in China and the United States continue to soften. And the third point, on the right chart, we can see how high and persistent inflation has led to a synchronized global monetary policy tightening that is reinforcing the demand slowdown. Europe responded quickly to the risks of rationing of gas due to a Russian gas shutoff. This was one of the big fears we had in our April outlook. Natural gas storage levels are filling up rapidly, but they are about average at this time of the year, as you see in the right chart, in the left chart. So we are on a nice edge with regard to rationing in the forthcoming winter. Energy security remains under threat, and energy prices remain very high, notwithstanding their most recent drop. Energy and food prices have accounted for about 2/3 of recent inflation, as can be seen in the left and the middle charts. But also, inflation has become more broad-based, and the persistence of core inflation has surprised on the upside. European labor markets continue to strengthen until recently, further raising potential inflation risks. And while this was accompanied by some pickup in nominal wage growth, especially in emerging European economies, a faster rise in price inflation has led to real wage declines, as shown on the right chart. As the energy crisis continues, real incomes are declining, and the buffering role of household savings, which were accumulating during the pandemic, may be weakening. Households are bearing a large burden from energy price increases in many countries, as shown on the left chart. Savings rates have normalized broadly during 2021, as can be seen in the middle chart. On the back of these forces, survey data suggests that weak consumer confidence in prompting a larger share of households in the EU 27 to revise downwards their planned major purchases in the next 12 months, as shown on the right chart. This bodes poorly for the outlook of consumption and GDP growth. Policy settings are also shaping the outlook. After central banks in emerging economies appropriately tightened monetary policy in 2022, central banks in advanced European economies are expected to follow suit in 2023, as can be seen in the right chart. On the fiscal front, our projections still incorporate some consolidation in 23, as can be seen in the left chart. But they do not fully factor in the recent or ongoing energy-related packages, which in many cases are moving the fiscal stance towards neutral or even expansionary for 2022. The confluence of factors affecting Europe at this juncture is projected to further weaken economic activity and add to inflation pressures in 23. We forecast output in 23 to grow at 0.6% in advanced Europe and 1.7% in emerging Europe, excluding Belarus, Russia, Turkey, and Ukraine. These forecasts are lower than our July forecast by 0.7 and 1.1 percentage points, respectively. This means that more than half of the countries in the euro area will experience technical recessions, with at least 2 consecutive quarters of shrinking output among these countries. Output will fall on average by about 1.5% from its peak. Croatia, Poland, and Romania will experience technical recessions as well, with an average peak to trough output decline of more than 3%. Next year, Europe's output and income will be nearly €500 billion lower as compared to the IMF's pre-war forecast. This is a stark illustration of the continent's severe economic losses from the war. In Ukraine and Russia, the war is projected to cause massive output losses. Ukraine should see GDP drop in 2022 of around 1/3, while Russia's GDP should be 10% lower by 2023 than we projected just before the war. Regarding inflation, we project headline inflation of 6.1% in advanced Europe and 11.7% in emerging Europe. These numbers have been revised upwards since July by 2 to 3 percentage points. Turning now to the risks around the outlook. For activity, the risks are overwhelmingly to the downside. The technical recessions we project for much of Europe could easily become deep recessions. New shocks to commodity markets could deliver another impetus to inflation. Inflation could stay higher than expected for longer if medium-term inflation expectations began to be anchored or workers obtained greater compensation for recent price increases. Importantly, social tensions may intensify in response to the cost of living crisis. Other downside risks revolve around new and lethal virus mutations and a more abrupt and sharper slowdown in key trading partners, including China and the US. Let me illustrate one prominent risk in more detail. A full and extended shut-off of Russian gas, combined with a cold winter, could require significant demand compression, as shown in the left chart. This might lead to physical shortfalls in some countries, although the likelihood of such shortfalls has decreased. We assessed that in July, but in the meantime, higher pipeline inflows and LNG flows and gas demand compressions have led to faster than expected storage accumulation in the EU in recent months. Due to infrastructure bottlenecks, the supply shortfall would be unequally distributed, with parts of Central and Eastern Europe being most vulnerable. The middle chart shows that the impact of reduced gas supply also works through higher prices of electricity and natural gas. For instance, the ex-ante impact of an additional 50% increase in energy prices vis-à-vis the first quarter of 22 would be a very significant hit on both the supply side, firms would face higher costs, and demand side, households would experience lower real incomes. Even without worsening of the energy crisis, inflation could stay higher than expected for longer. Looking at our empirical models of inflation, there is a risk that the pandemic and the war could have made inflation much more persistent than projected under the baseline. Even after taking into account the large contribution of energy and food to the recent inflation surge, almost half of recent core inflation is unexplained, as you can see from the gray bars in the left chart. Looking across countries, this unexplained inflation correlates with measures of input and labor shortages. This suggests there may be less economic slack and accordingly more underlying inflationary pressures than commonly thought across Europe. Inflation could become even more persistent because of a de-anchoring of medium-term inflation expectations. For example, in the form of a wage spiral, which could be triggered if workers and firms starting setting wages based on recent inflation rather than central bank targets. So far, wage growth has picked up only modestly, at least in Western Europe, but some further pickup is in the cards. To be clear, higher wages need not be a cause for concern as such, but what needs to be avoided is a sharp acceleration that would trigger an adverse feedback loop between prices and wages. Our assessment is that price-wage spiral risks are still low, but they have risen, and our analysis shows that both the pass-through from prices to wages and from wages to prices is much stronger when prevailing inflation is high, a condition that is clearly fulfilled right now, and when central bank credibility is low. If inflation risks materialize, how would central banks need to respond? Using simulation analysis, we find that if inflation became as persistent as it was prior to the 1990s, due, for example, to an adverse price-wage feedback loop, or inflation expectations became de-anchored, actual inflation could be nearly 2% higher at the end of next year across advanced European economies. In this case, policy rates may need to rise by 2 percentage points, and output could fall by as much as 2 percentage points more than we currently project. But while inflation risks are predominantly on the upside, inflation could also well surprise on the downside in a highly uncertain current environment. Commodity prices could turn out to be lower than assumed in our projections. Also, recessions could deepen. For example, should a further decline in demand reduce projected output by 1%, inflation would ease and required policy rates would be lower. What do these inflation risks imply for monetary policy? Because inflation risks are predominantly on the upside, central banks need to take out further insurance against these risks ex ante. At the same time, because uncertainty is very high and recessions could get deeper, central banks need to stay nimble and they need to stand ready to adjust in both directions, depending on whether incoming data signal a deepening recession, higher than expected inflation, or both. European central banks are taking action, of course. Emerging Europe experienced earlier and wider inflation deviations from targets, and policy rate hikes appropriately started earlier, as shown in the left two charts. On the right, and as part of the post-pandemic monetary policy normalization, most central banks stopped balance sheet expansion by end 2021. Going forward, central banks across Europe should be raising policy rates. More action is needed in advanced economies, which started tightening more recently. But overall, monetary policy stances should be comparatively tighter in most emerging European economies, where inflation is higher. Expectations are not as strongly anchored, cyclical positions are more robust, and nominal wage growth is higher, carrying risks of more protracted wage price feedback loops. Should demand weaken more than anticipated and push Europe into a fully fledged recession, policy normalization could generally be slowed as long as wage pressures are contained and inflation expectations are anchored. But if a recession instead was triggered by additional supply shocks, such as a full Russian gas shutoff, central banks should face tougher choices. They should then focus on avoiding wage price spirals and the de-anchoring of inflation expectations, which might require further policy rate increases. They should stand ready to slow or pause if instead the medium-term inflation outlook weakens substantially. Turning now to the fiscal policy side, my main messages are as follows. First, some withdrawal of fiscal accommodation is warranted, but the extent needs to be country-specific. Second, fiscal policy needs to be ready to provide more support at vulnerable consumers and viable firms should the threat of deep recession become large. And third, more should be done to structure fiscal support in a manner that does not suppress energy price signals. The ongoing energy crisis is creating important challenges. The left chart shows that many governments in Europe have taken measures to avoid a full pass-through of commodity prices to households and firms. This could have large economic and social costs. However, such measures should be kept temporary as they are quickly becoming expensive and price signals should be maintained. A better option is to support households through lump sum rebates on their energy bills. They should be ideally targeted to low and middle income households. That way, the incentives to save energy will be fully preserved. Targeting could be achieved with limited information requirements by combining lump sum discounts on the monthly bill for everyone with additional support for the poor through the welfare system and with higher taxes for high-income households. Higher tariffs for higher levels of energy consumption, which some countries have implemented, those are block tariffs or lifeline tariffs, are not fully targeted, but are a better option than broad-based price caps. To provide some numbers for 2022, the increase in the cost due to the increase in energy prices is 7.1%. Compensating fully the bottom 20% would cost 0.4% of GDP. Compensating the bottom 40% would cost 0.9% of GDP. For 2023, the increase in the cost of living is projected to be 9.3%. Again, making the bottom 20% whole would cost 0.5% of GDP. 40%, the cost would be 1.2% of GDP. Fiscal costs in 2022 so far are estimated by us to be on average 1.8% of GDP, and some of the package are vastly larger. In some countries, fiscal pressures are coming not only from the cost of living crisis, but also from the refugee crisis, as shown in the middle chart. Finally, fiscal space, as financial conditions continue to tighten, spreads for government bonds also increase, as you can see in the right chart. These factors call for fiscal consolidation during 2023 and more so in emerging economies where the cyclical recovery has been faster. Turning now to financial policies. Our RIA shows that the private sector is entering the current turbulent period with relatively strong aggregate balance sheets. European households and firms have deleveraged, and banks' capital adequacy ratios have improved in both emerging and advanced European economies. There are pockets of vulnerability, however. A weaker growth outlook and the tightening of financial conditions shown in the left chart will reduce households and firms' debt service capacity and push banks to tighten access to credit. Healthy banks' balance sheets should help contain such tightening. In this context, macroprudential policy settings can remain broadly unchanged, while vigilance should be increased over potentially vulnerable sectors such as housing. As shown in the middle chart, it will be important to assess vulnerabilities linked to over-indebted households, especially in countries where adjustable rate mortgages are predominant. As for non-financial corporates, the right chart shows that some of them, especially SMEs, are also sensitive to a tightening of financial conditions. As an illustration, the chart shows how the share of the firms considered able to service their debt would fall under an adverse scenario featuring a 200 basis point interest rate shock relative to the baseline and a 10% negative shock to corporate earnings. Finally, regarding the many structural priorities, the focus at this juncture should be on ensuring energy security along with a continued commitment to the green transition. Beyond this, long-standing structural reform priorities aimed at boosting productivity and easing factor reallocation through more flexible labor and product markets remain crucial. Easing pressures in energy, labor, and product markets will ease supply constraints and inflation pressures down the road. The next generation EU is an important pillar of this agenda. One word of conclusion. Europe managed to pull itself out of the COVID crisis through swift and strong policy responses, coordination, and European solidarity. Once again, the task ahead is immense, but if European policymakers master the spirit of the pandemic response, we believe it can be accomplished. Thank you.
Well, thank you for that presentation. And I must say you didn't really leave much space for optimism. Quite a few things to be concerned about. And given that you were brave enough to bring your presentation and your
recording stopped.